The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and thank you so much for taking the time to join us today for our webinar on employee stock options. My name is Nick Defenthaler, and I'm the lead financial planner here at the center, and I'm also the director of our firm's financial planning department. Today, I'm really excited to discuss a more nuanced topic today, just to hopefully provide some education on an area that we typically find causes a great deal of confusion. So employee stock options can really be an incredible add-on to your overall compensation plan. And if you're eligible for them, you certainly want to have a firm grip on how they function, or be ideally working with a professional to help you navigate some of these nuances that we're going to touch on today. Just one quick housekeeping item before we dive in, because I certainly want to be respectful of everyone's time today and stick to our 45-minute time slot. We have disabled the chat function on the webinar, but if you do have any questions, feel free to shoot me an email after the presentation. At the very end, I'll have a link to our website and a copy of a list of my email address and contact information. You can certainly give me a shout afterwards, and I'm happy to answer any questions that folks might have on the call or on the recording. So with that, we will dive into the content. So I wanted to preface the discussion and just kind of go over a few of the main concepts that we're going to touch on today. So stock options are fairly complicated, but at the same token, they're not. I don't believe they're as bad as what some people make them out to be as far as a level of complexity. So we're going to go over some of the basics that I think are really important for folks to have somewhat of an idea on how they function if you are eligible for these at work. But I'm not going to go into the nitty-gritty because we just simply don't have time for that, and I don't want to bore everyone to death on all the possibilities that you might encounter with stock options. So that's what we help clients with on an ongoing basis if folks do have these as part of their comp plan. So the things that we're going to talk about today simply go over: why do employers offer them? What's the point? How long do you have to keep them as an employee? What are the most popular types of stock options? There's a few. So we're going to go over a few of the most popular ones that we typically see. And I really think this is the most important piece. So we're going to go over a short case study at the very end on, how do I actually factor this into my overall financial game plan? Your stock options and all these different forms of your comp plan are extremely important, but at the end of the day, if you don't have a sound financial game plan, or you don't have a strategy on how to implement these into your overall long-term goals and objectives, you're kind of just shooting from the hip. So it's very important to know how we can implement these into your own personal financial game plan. So we'll start with, why are they offered? So employee stock options are typically offered to higher level executives at a company. Or oftentimes I've even seen, at startup firms. So companies use stock options as a way to attract, retain, and motivate employees. Those three simple things. So if you are lucky enough to have stock options, it's probably because you're making really good money, or you're at a firm where there's the potential where the company can really take off. So they're trying to motivate you to really have great performance as an employee, to chip in and do all the great things that you're doing in your role to, in theory, drive up the stock price. So that's kind of the why behind it. A very, very important component of stock options is a vesting schedule. So many people have heard about vesting schedules, very similar to a 401k plan, where in regards to a company match. So in many 401k plans, you might receive a 4% company match. But if you leave the employer within, let's say, 3 to 5 years or something to that effect, you receive only a portion of that match that ultimately hit your account. So you're incentivized to stay with the company to ultimately receive that full benefit that was deposited into your account. It's the same kind of concept as it relates to stock options. So I think this is kind of a neat little simple graphic that shows, kind of a timeline essentially, where if there were 1,000 stock options granted to you, over the course of 3 years, you're going to have access to 33% of those each and every year. So there's incentive as the employee for you to stay on board and keep working hard for that company over that 3-year time frame, because each and every year you're going to get a little bit more of your total amount of options that you were granted. And I'll go into some of the mechanics here in a few, but I just really wanted to preface the conversation with a couple of the key terms that I'm going to be using throughout the presentation, because there are a few different, some lingo that we use in relation to stock options. So I just really want everyone to understand some of the foundation of how these function and what the key terms are. So as you can see, after year 1, this person has essentially 333 options that have vested, because there's a 33% vesting schedule over the course of 3 years. So after that 3rd year, the client is going to be 100% vested. So that essentially means that they have access to do whatever they want to do with those options at that time frame. If they were to leave the company, let's say in year 2, they're only going to be able to have access to about 333 of those stock options that were initially granted. So as I mentioned, just kind of circling back to the why, why do employers offer these? And a big part of it is to incentivize employees to work really hard, in theory, drive up the company's stock price, but also as a form of incentive for people to stick with the company. So as you can see there, they do this financially and say, if you stick with the company for a period of time, you could potentially own the bulk or all of these options that we're going to grant you at a specific time throughout the year. So as I mentioned, we're going to discuss a few different types of stock options. One type is a non-qualified stock option, and the other type that we're going to discuss today is a restricted stock unit. Now, you may have heard of an incentive stock option before, an ISO, and I'm not going to spend any time on that today because there are a lot of similarities between those and non-qualified stock options. But the main reason why I'm not going to touch on it is because we're really not seeing those come up as much anymore. Employers have kind of shifted away from utilizing those, and I won't go into the why just for the sake of time. But primarily with clients that we work with in today's world, the majority of the time when folks have options, it's either going to be these non-qualified stock options, NSOs, or restricted stock units, which I'll talk about in a few minutes. So I just wanted to start with some basics about NSOs. Okay, so think of a non-qualified stock option as a written offer from an employer to sell stock to an employee at a specified price within a specified time period. Okay, and I'm going to go over all these, and I think with the example that I have at the very end, we'll kind of tie each one of these points together. It's a valuable form of additional compensation for key employees and a form of incentive, as I've discussed previously. One very important component of an NSO is that the stock option can potentially expire worthless if there's no action taken, or if the grant or exercise price is less than the market price upon the vesting of your shares. So in that previous slide that we saw, we looked at a vesting schedule. So if you're granted an NSO, a non-qualified stock option, and you hold that stock and throughout maybe a couple years or so, and it's fully vested, and you take a look at the price that's currently trading in the market, if the price that you were granted that option on is actually less than what the current market price is, there's really no value to exercising that option. However, if it's higher, if it's more than that, you could potentially sell the stock for a substantial gain and you pay a much lower price for it. So we'll take a look at that in just a second. Some very important pieces of stock options, whether they're NSOs or RSUs, are tax implications. So the way that taxes work with NSOs, and this is one of the more confusing areas for clients, people get tripped up on this quite frequently on, how do the taxes work? Am I taxed when I receive them? Am I taxed when I sell them? How does it work? Okay, so typically, in almost all cases with NSOs, when you're granted these options, or think of granted, you're given these options in the first place. there is no tax implication whatsoever when you're granted the options, okay? If, however, upon vesting of that stock, you ultimately exercise those options, and like I said, we'll take a look at an example in a few minutes. If there's a gain or a difference between that grant price and the market price, and you exercise those options, there could potentially be a taxable event because there's a gain. So if there is a taxable event, the way that the gain is essentially coded, I guess, from a tax perspective, just think of it just like earnings on a W-2. So it's taxed as ordinary income, and you're also going to pay tax associated with payroll, payroll tax or FICA, Social Security or Medicare tax. So that's roughly, about 7.5% or so. So there are certainly some tax implications, and I think a lot of people get hung up on the whole tax side of things with options. If you kind of reframe the thought process and you say, you know what, I really have to take a step back and think in the sense that this is part of my overall compensation. I can't really get too hung up on, yeah, I am going to pay some higher taxes because of these. Because if you thought of this part of your compensation just as your base salary, you wouldn't even be thinking twice about the tax implications, because we're so conditioned of thinking as, you know what, my base salary or a bonus that I receive, I pay tax on that, it is what it is. But for some reason, the way our brain works when it comes to stock options, we get very hung up on the fact that, these are going to create a tax liability. But at the end of the day, as I mentioned, it's a form of compensation. So that's how you really have to reframe the thinking in your mind if you're entitled to these and you're really getting hung up on the fact that there's tax implications with it. So I'd encourage you to kind of take a step back and think of it a little bit differently if you're struggling a little bit with facing that annual tax bill that options can ultimately produce in some cases. So let's take a look at a quick example. So Mark works for XYZ company as a team leader and is granted 500 shares of company stock with an exercise price of 60. Okay? So if we fast forward 1 year and the stock is now trading at $80 a share in the open market, because of that run-up in price, Mark can ultimately decide to exercise 250 of those shares that have now fully vested. So every company and every position is going to have a different vesting schedule. So that's that timeline that we looked at a couple slides ago. So the way that Mark's vesting schedule works is he's entitled to, it's a 50% vesting schedule. So after year one, he's out of those 500 shares of options, he's entitled to half of them. So that's kind of what we're looking at here in bullet number 2. Because that price has gone up $20 a share from 60 to 80, he's elected to exercise the 250 shares that he's entitled to. So let's take a look at on how that plays out from a dollars and cents standpoint. So because Mark was granted these options at $60 a share, he can exercise them now because they're fully vested, or the 250 shares are vested, and essentially sell them in the open market for the market price of that $80 a share. So that total gain that he's looking at is about $5,000. So he's essentially purchasing the total position for roughly $15,000 and exercising it and going through the motions with the exercising of the options, and then turning around right away and selling them in the open market for a total of $20,000. So that difference between the two is where the gain is coming in, okay? And that's ultimately what's going to hit your bottom line, and that's what is going to create wealth for the client. So that $5,000 gain, if we're looking at that last bullet point, is considered taxable compensation to Mark. In most cases, it's going to be included in his W-2 at the end of the year. In many companies, because they know that obviously stock options create a tax liability, they will withhold a certain amount of shares or dollars when these are exercised, so that way you don't get hit with a large tax bill at the end of the year. That's very, very common. But obviously, I would encourage anyone on the call or who's listening to the replay, if you do have options, make sure you check with your HR department or your benefit provider to make sure that, if you do have these, do you have to set aside taxes on your own, or is that something that the company is doing for you? So non-qualified stock options are a little tricky. There's a couple different components here. So hopefully this example sheds some light on the different avenues that it could go if you do ultimately decide to exercise an option that you're granted that's fully vested. So the next area or type of option that we're going to talk about today is a restricted stock unit. So some basics about the RSUs. Very similar to NSOs in regards to this part of the discussion. Written offer from an employer to sell stock to an employee at a specified price within a specified time frame. It's a valuable form of additional compensation and a way to incentivize employees. The major difference, however, and I just want to focus in on this for a second, unlike an NSO, as long as a stock has, as long as your company's stock has value and you're granted an RSU, there will be value to that RSU. And I know that might seem a little bit tricky in trying to remember the differences between, okay, what did Nick just explain with the RSU and how did the NSOs work? So if we try to remember back to the previous slide in regards to NSOs, non-qualified stock options, remember that the market price that your company stock is trading at has to be greater than the grant or exercise price currently is at that time for the option to have any value. A restricted stock unit, on the other hand, you're essentially granted company shares. Here you go. You're a great employee. I want to incentivize you. We're going to give you company stock, and the more you work hard, hopefully you drive up the stock price, and you don't have to worry about hitting a particular price target. Now, of course, you want the stock price to rise. That just means the total value of your shares are going to increase. But almost think of this as someone gifting you shares of stock. That's kind of the easiest way to think about RSUs. So because of the way that these function, they're traditionally a lot less complicated, and they're a little bit more conservative than non-qualified stock options. And the reason why I say they're a little bit more conservative is just reverting back to how NSOs function. As I mentioned, the market price has to be greater than that exercise price for the option to have value. That doesn't exist with an RSU. As long as your company is still in existence and the stock price has value, your RSU is going to have value. So I think that's a very, very important component to the discussion. Now, looking at some tax implications. Same type of situation for bullet point number 1 as it is with NSOs. Typically no tax due when RSU is granted. Okay, so when you receive these, doesn't mean anything to you from a tax perspective whatsoever. Any sort of gain that you're going to see is when these shares ultimately vest. So once again, kind of going to circle back to that previous slide, that timeline, that arrow that we looked at in the beginning of the discussion. Over the course of several years, a portion of these shares that you're granted are going to vest, and you're going to have access to them. So you don't face any sort of tax implication until that vesting ultimately occurs with RSUs. And same thing with NSOs. RSUs are treated as compensation, so taxed at ordinary income rates and subject to payroll tax as well. Think of it essentially as another form of W-2 income, just like NSOs. So let's take a look at a quick example for restricted stock units. So Sarah works for a company, ABC company, as a team leader and is granted 500 shares of company stock with a 5-year vesting schedule. And the stock price is currently trading at $30 a share. Okay, so what does that mean exactly? The 500 shares in the 5-year vesting schedule. This is very important. So over the course of 5 years, Sarah is going to be entitled to 100 shares per year. And like I mentioned, every company structures a vesting schedule differently. It's totally different on your position, on the company that you work for, etc. A 5-year vesting schedule is fairly common, And once again, reverting back to the why. Why do employers offer these to employees? And it's a big reason why is, Sarah is incentivized to stay with the company for 5 years, because if she doesn't, then she's forfeiting a portion of her options, or her RSUs in this case. Okay, so if we look at the second bullet point, let's fast forward 1 year, and the stock is now trading at $40 a share, and 100 shares of Sarah's RSUs are now fully vested. So the stock price now is $10 more a share than it was a year previously when Sarah was granted the options. So how does that work out from a dollars and cents standpoint for Sarah? So 100 shares of the ABC stock valued at $40 a share, or $4,000, those shares are deposited into a brokerage account, whether it's at Scottrade or at Fidelity or something to that effect. The shares are ultimately deposited into a brokerage account into your own name as an employee. Now, Sarah can do one of two things. She can maintain those shares within that brokerage account, or she can immediately sell them. And in most cases, we recommend to clients that they sell them immediately and diversify the proceeds that result from the sale of the RSU. Now, some clients say, you know what, no, I want to maintain the actual shares that I was granted. The risk of doing so is that the stock price can ultimately go down. So if you think about it from this perspective, no matter what Sarah decides to do here, whether she keeps the options or whether she sells them upon vesting, she is going to pay tax on this $4,000, okay? So if the stock price decreases substantially and she elects to keep it, well, she just paid tax on a stock that has gone down significantly. So you got to be aware of those sorts of things and kind of plan ahead. So the way that our firm invests and kind of views the world and views portfolios is we try to strive for asset allocation and diversification. Okay, so in most cases, not every single one, but in most cases, we do recommend that clients actually sell the shares and diversify those proceeds accordingly. Because in many cases, this isn't the only form of company exposure that the client has. So we don't want you to, as an employee, to be 100% dependent on this company for your income. And over time, if you're just allowing these RSUs to vest and you're maintaining those shares, you now have a substantial asset within that company that is potentially held in that you're going to use for retirement. And if that company experiences a downturn and you lose your job, well, chances are the stock price is falling too. So it's a double negative. So we really take a close look at that. And like I said, in most cases, we want clients to diversify and ultimately sell those shares of RSUs when they vest. All right, so now this is just kind of a lighthearted, cute picture of a dog wagging its tail. And I think this is really important from a tax perspective because we've talked about taxes quite a bit here. There is a saying, I don't know if everyone on the call has heard it or not, but there's an old school investment saying, don't let the tax tail wag the investment dog. So that essentially means don't let your investment decisions be driven solely by tax implications that are associated with it. Now, don't get me wrong, taxes are an extremely, extremely important of stock options, of your overall financial game plan, of how we strategize different retirement accounts for clients, and I'm going to go into some of those things in a few minutes. However, it should not be the sole driver of your decision on whether or not you should essentially exercise an option or sell that particular RSU, in our humble opinion. Because we've seen it happen so many times where clients say, I'm making more money this year, I'm in a higher bracket, I don't want to generate any additional income by exercising these options. And we've seen it happen where they hold off and they don't pull the trigger on exercising, and the stock price takes a dive. Well, now you have zero value and you can't exercise it, and you would have been better off exercising it at a higher stock price, paying the tax, because you still would have had a gain. Well, now you're in a position where the stock price has taken a nosedive and maybe now that option has expired and you can't do anything with it. So that's why we say, don't let the tax tail wag the investment dog, because when you do that, usually bad things happen. Okay, so as we kind of wrap up in the discussion, because I want to be respectful of everyone's time, I thought it would be really beneficial to take a look at a case study. And I think we've gone over some of the nuances between NSOs and RSUs and how stock options and stock units can function. But I really wanted to shed some light on how we would typically approach a client case if someone had access to these sorts of options, or options were a part of your overall financial game plan. Because there's many other things that we're taking a look at as financial planners to take into account, if we are exercising these, what are some other things that we can be doing to potentially ease that tax burden? Or are there other things that we can be doing to diversify your overall portfolio, et cetera? So that's what I just want to show folks right now as we walk through this case study. It's very similar, actually, to a recent client case that we saw. So this is very relevant. So Mike, age 55, and his wife, Stacy, both IT execs with Microsoft, and a combined annual income of $450,000. As you can see, that income level is quite high, and typically folks who are granted either NSOs or RSUs are folks who are making really good money, like Mike and Stacy. Okay. Recently, they are now entitled to receive non-qualified stock options as well as restricted stock units, and those are going to begin vesting in June of 2018. So this year they're granted the options. They're not going to actually start vesting until next June. So being that this is a new form of compensation for them, they're a little bit confused. They reach out to the center. They've heard that there's some financial planners here at the firm that are really well versed on how options work and how to implement them into the overall financial game plan. So they reach out to us and say, how the heck do we navigate these? Help us out. We're not too sure on what to do with these or how to fully maximize them. So just to kind of frame the conversation a little bit, here's a breakdown of the overall assets that they've accumulated. Okay. So Mike and Stacy both have sizable 401k accounts at Microsoft, currently maximizing both of those. Because they're over the age of 50, they're allowed to contribute $24,000 a year into this account. They also own several different Roth IRAs, and we'll talk about kind of the strategy of funneling money into those in a few minutes. $6,500 a year is going into each Roth. And then they also have a taxable brokerage account, so a non-retirement investment account. Okay, so it's not tax deferred. There's not a whole lot of preferential tax treatment with that type of account, but they're already maxing out these other vehicles, but they still have the capacity to save. So this joint brokerage account is really the next best place for them to defer additional dollars. So they're contributing about 12 grand a year to that particular account. So total investable assets just shy of $1.7 million, and the annual savings rate is approximately 16%. So typically with clients in this age group or in this age range, we really want to see that savings level at about 15 to 20%, because typically in those years you are really trying to accumulate as much as you possibly can in the years leading up to retirement. And when you're making really good money like Mike and Stacy, chances are you have the capacity to do so. So briefly, just kind of taking a look at their overall asset allocation, a little bit aggressive, currently about 80% stock, 20% bond. And because they've been very loyal employees with Microsoft, they've always had faith in the company and in the company stock, they have a really large concentration of the Microsoft stock fund within the 401k of about 25% of the overall account value. So when we're working with Mike and Stacy and we're kind of digging through their overall financial game plan, these are things that we're identifying. We're taking a look and we're saying, okay, what are some things that we could be doing to help you guys maximize your wealth, maximize your tax strategies, maximize your stock options? Okay, so let's look at a few different areas that we would potentially give some guidance on for Mike and Stacy. The first section, or the first category rather, would be in regards to their overall asset allocation and managing their overall portfolio risk. Okay, so one of the first things that we would probably recommend to Mike and Stacy is, you know what, we really want to trim down that Microsoft stock exposure that you have in your 401k. It's far too high to have in one company. Okay, so typically we don't want any more than around 5% or so in any given company stock within an account. Now every situation is obviously a little bit different. It's not a blanket statement, but that's typically where we've kind of found the sweet spot where, you know, you're not taking on a dramatic amount of company-specific risk like Mike and Stacy are currently doing. So by doing so, that can dramatically reduce the overall company risk level that they currently have, and also improve the overall level of diversification of their entire portfolio. The nice thing about, if anything, of having this substantial holding of Microsoft stock fund in their 401k is because they've held it for so long and they have a gain, well, it's in the 401k. So if you sell it, there's going to be no taxes associated with it whatsoever because the account's tax deferred. So it's a great way to diversify the client's portfolio in a tax efficient manner. So the other category that we're going to look at, okay, well, they're now receiving stock options and RSUs. What types of things are we giving them advice on in regards to those items? So each and every year in June, we're going to set up a reoccurring meeting or a recurring task to reach out to Mike and Stacy and touch base with them and say, okay, you know, it's been a year and some of your options have vested. Let's take a look at these. Let's dive into things. We're going to have our investment department take a look at the outlook for Microsoft stock. Where's the stock currently trading? Where are analysts predicting where they see the target price at, et cetera. And obviously, we're going to take a look to see, is the stock option even worth anything in regards to that non-qualified stock option that they have now received? Is the market price greater than that grant or exercise price in that other example in the previous slide that we looked at? If not, there's really not much we can do at this point. We have to kind of wait it out and wait till that market price gets a little bit higher. In regards to their RSUs, on the other hand, as we mentioned, there's really no action that you need to take with an RSU. You're essentially, quote unquote, gifted these shares from your employer, and you don't have to take any action or make a decision that's dependent on the stock price. As long as Microsoft is still in business and as long as the stock still has value, your RSU is going to have value. So as I mentioned, you know, in most cases, we're going to recommend that clients sell those shares that ultimately vest each year in June, and we're going to diversify things and not hold a high concentration stock position in Microsoft that the client works for as well. Many employers offer the employee, or they give them the option, you know, do they want a certain amount of NSOs? Do you want a certain amount of RSUs? We're seeing more and more companies give the employee the option of what type of stock option they want. So in Mike and Stacy's case, because they're in their middle 50s and, you know, retirement's probably 5 to 7 years out for them, we want to go with something a little bit more conservative, a little bit more of a conservative approach. So RSUs, in theory, are traditionally a more conservative option than NSOs, because as I mentioned several times, as long as Microsoft is in business and the stock has value, the RSU will have value. We cannot say the same thing with NSOs. Now, that doesn't mean NSOs are bad or that RSUs are better. It just means that this is slightly is a little bit more of a conservative approach. Okay, NSOs have the potential to really take off, and we've had clients who have really done quite well with NSOs. However, there is a lot of uncertainty with those because the market price has to get to a level that exceeds the amount or the price that the grant price that you ultimately receive the stock at. So there's some variables there. So traditionally, we like to go with a little bit more of a conservative route and say, you know, go with the RSUs for clients who are nearing retirement. But obviously, everyone's situation is a little bit different, and those are the things that we're going to look at with you. Now, I know this one's a little bit it's kind of a lot to look at, but as I mentioned, there's a lot of things that we can do from a tax perspective to help offset some of the tax implications that come along with potentially, either exercising the options or having these RSUs vest. Because as I mentioned earlier, we don't want the sole decision of whether or not you exercise an option to be because of the tax liability is going to be high. There's other things that we need to look at as well in conjunction with that to make the most informed decision. So let's say the client exercises some options and the income is going to be, $20,000 to $50,000 more than normal because the stock price has gone up and you're going to have to pay some tax on that. Okay? So what are some things that we can control? We can't really control tax liability that's associated with the options. We exercise those. We want to take some profit. You're going to pay tax on it. It is what it is. There's nothing you can do about it. There are, however, some strategies that we can look at in other areas of your financial life that can hopefully offset that tax liability a little bit. So that's what we're going to kind of look at here for a second. So a major thing that Mike and Stacy, 100% we would recommend that they continue doing is fully maximizing their the pre-tax portion of their 401k plan. Now, many 401k plans now offer a Roth 401k component to the plan, but typically when clients are in high tax brackets like Mike and Stacy, the pre-tax or traditional 401k option usually makes the most sense. Okay. Now, many companies, if you're being offered stock options, chances are you're probably at a level in your company where you're also entitled to other forms of employee benefits that maybe other rank and file employees aren't entitled to. So I won't go into the weeds on this, but deferred compensation plans are quite popular with larger companies. They do have obviously some risks associated with them that I'm not going to dive into right now, but contributing to a deferred comp plan in addition to the 401k could also be an excellent choice to at least explore, because the amount of money that you're putting into the deferred comp plan is going to reduce your overall taxable income for the year. You obviously want to go through this with your financial planner, talk through things, see if it makes sense given some of the inherent risks that are associated with deferred comp plans, but it could potentially be a great option to at least explore if your company allows for it. So let's say Mike and Stacy are very charitably inclined. They normally give away $10,000 or $15,000 a year of their income. It could really make a lot of sense in years where income is a lot higher because we're vesting options to increase those charitable contributions, especially in the years leading up to retirement. We call that front-loading charitable contributions. So in the years leading up to retirement, when you're in a really high bracket or you're experiencing the highest income level of your entire life, getting a tax deduction in the 35% tax bracket is far more meaningful than receiving a tax deduction when you're in retirement at the 25 or 15% bracket, because chances are your bracket's going to get lower once you go into retirement in most cases. So it could make a lot of sense to say, you know what, I'm going to really juice my charitable contributions, and then when I retire, I'm not really going to have to worry about making those contributions for a few years because I front-loaded them before I stopped working, and I really got the most bang for my buck from a tax perspective. Now, we don't contribute to charity, obviously, solely based on the tax implications or the tax benefits. But the way that I look at it is, if you can give money to charity and save on taxes, that tax savings could potentially translate into additional dollars that you can now give the charity that you're really passionate about. So that's kind of the way that I like to think through it. Now, we saw those Roth IRAs, going on to that third bullet point here, the Roth IRAs that Mike and Stacy have. I'm not going to spend a ton of time here because I know we're kind of pushing up against our time limit, but each and every year we're doing what's known as a backdoor Roth IRA conversion for them. So this isn't going to do anything for their current tax liability for the year, but because Mike and Stacy make a significant amount of income, they're not allowed to contribute directly to a Roth IRA. They're over an income cap where the IRS says, you know what, if you make over roughly $185,000 and you're married, you can't contribute to a Roth IRA. There is a workaround for that, however, where you can contribute to a non-deductible traditional IRA and immediately convert it to a Roth, and that's what we're talking about here. So as I mentioned, it's not going to do anything to reduce their current tax liability. However, it's good planning for the future. The way that I always frame it with the clients that I work with is, just how we try to diversify your portfolio and the investments within your retirement accounts. Ideally, we want to diversify the type of tax treatment that those accounts have as well. So building up this tax-free bucket of money within the Roth IRA is going to give the clients a huge level of flexibility in retirement because they have different buckets to pull from that have different tax treatment. So we can try to maximize tax brackets a lot more efficiently when they are ultimately in retirement and they're in that distribution mode. And then the final item, and I think this is really important, and our investment committee and our investment team does a fantastic job of this for clients, is really evaluating the tax efficiency of Mike and Stacy's investment portfolio. So certain mutual funds, ETFs, stocks, bonds, they have different tax ramifications. So it's very, very important that you're intentional with where you house those particular assets or those particular types of funds, whether it's in a 401k or a Roth IRA. Typically, we want less tax-efficient funds. So bonds that are kicking off ordinary income interest, or international stock mutual funds that might pay out a larger capital gain distribution at the end of the year. If we can try to house a good portion of those types of mutual funds in accounts like Roth IRAs or 401ks or traditional IRAs, you're not going to pay any tax immediately on those because they're tax deferred. So even though these specific investments might not be all that tax efficient, the asset location of those positions, it's very, very important because that reduces the tax drag that you have on the overall portfolio performance. And so on the flip side of things, we want to have more tax-efficient types of funds within the joint taxable brokerage account that doesn't offer tax deferred. So for Mike and Stacy, this could be something like a municipal bond fund that's going to provide them tax-free income because of the bracket that they're in, or even using some exchange-traded funds that aren't going to pay out any capital gain distributions at the end of the year. So it's very, very important that we take a look at your overall portfolio and use that bucket strategy, so to speak, with your overall allocation and say, okay, which type of fund or what type of asset class makes the most sense to have in each specific account? Because every account has a different tax treatment. So when we do all of these things together from a tax standpoint, it can really help mitigate some of that tax burden that you might see from vesting some of these options. You're still going to pay tax. You're generating additional income and additional wealth. It kind of comes with the territory. But if we can be efficient and do some of these other things to mitigate the tax bill, then by all means we certainly want to explore that. So I think we're about 2 or 3 minutes before the time for our allotted time slot. So I certainly appreciate everyone taking the time today to learn a little bit more about employee stock options. As you can see, I just spent almost 45 minutes going over some of the basics with stock options, and we just started scratching the surface. So these can be a little confusing for clients, and they can make you scratch your head at times when you see them on a statement. So by all means, if you have access to these, or you have friends or family or coworkers that have access to options, whether they're NSOs or RSUs, if you have a question, have them reach out to us. We're happy to be your resource. We see these frequently with some of the clients that we have, and if used properly, they can be a tremendous tool. As I mentioned, if you do have those questions, reach out to me. My email is listed on the slide. We're going to send out a copy of the recording of this webinar in about a week. And I would encourage you also to take a look at our website, www.centerfinplan.com. We've got a lot of other great resources between our blogs and past webinars that you can take a look at. Very educational in nature, and you can learn a lot by visiting our website. So once again, thanks to everyone for taking the time today, and I hope you have a great rest of the week.